Please welcome the panel on Bending the Curve, Innovation in Asset Management, moderated by Vice Chair of Client and Banking, Citi, Leon Kalvaria.
Good afternoon and welcome everyone. Thank you for joining us today in what is a very timely topic, and that is how digital assets are reshaping the future of asset management. And obviously, we're all doing a lot of reading about it lately, given what the administration is doing. But frankly, equally importantly, over the last year, we have witnessed several major inflection points in the marketplace. One of the most significant being the SEC approval, long-awaited, of spot Bitcoin ETFs, which was really the beginning. And I think what that did, I think AUMs for the ETFs right now are over 100 billion. But importantly, much as we have crypto natives in the audience and on the stage here right now, traditional asset managers have adopted it. We have great representation from Franklin Templeton, which we'll talk about later on, but BlackRock, Fidelity, Grayscale, and it's a staggering vote of confidence. In effect, people saying that after 10, 12 years, probably 12 years, this asset class, broadly defined, has a serious place in terms of wealth management. And we're going to discuss that. And actually, interestingly enough, as we were preparing for the panel, I looked at how the price of the assets hung in there during the recent market volatility, and they were a good store of value relative to other things. So that's a great start. And then, as I alluded to, along came the Trump administration, the president of crypto. A sea change in the industry that I think is highly unusual but very interesting. I think coming from an administration in the past that was perhaps less friendly, we now have something that's incredibly friendly. And I think leadership in terms of legislation, but also important recognition that the digital infrastructure is a strategic priority. It's for the US and globally, and that digital assets are not things that need to be tolerated, but they need to be actively embraced in board meetings and strategically integrated. So that's a massive sea change, and we'll come back to regulatory issues, how that affects both institutional management, but also the retail side. So that's why this discussion is timely and fascinating. We're joined by a great group of visionary leaders right now, and they span the spectrum from crypto-native innovators, traditional asset managers, venture capital pioneers. And I think now let's go unpack this transformation across real-time products and see how the asset management industry is leaning in. So let me start out by introducing our panelists, and it's been a pleasure to get to know them. Eric Anziani, President and Chief Operating Officer of Crypto.com, also known as the sponsor of Miami F1, where he was just at. And what they have done with 140 million users, 100 licenses around the world here right now, they have transformed the business, especially from a retail standpoint, on a global basis. And as you say, crypto in every wallet is the vision. And it'll be interesting to see over time how, in fact, that gets into the retail landscape. Sandy Kaul, aside from being head of Franklin Innovation Research and Strategies, is with a firm where, through her and her chief executive, they have really leaned in to meaningfully engage in blockchain technology through investments, Bitcoin, Ethereum ETFs, and importantly, maybe most importantly, Sandy is an alum of Citigroup, which gave her the foundation of everything. John Koudounis. John has done an amazing job with Calamos Investments, over 40 billion in AUM. And as a diversified global investment firm, we're going to come back to why he entered this, which is actually quite fascinating. But they've also done interesting product innovation in terms of providing what I would call a hedge product with upside and downside adjusted, downside protected, and a fair amount of upside. And as we go through it, it'll be interesting to know how that product has been accepted in the sector. Then we get to, in some ways, the crypto natives. Peter Mintzberg, the CEO of Grayscale, the world's largest crypto-focused asset manager, And his leadership here right now has provided the broadest amount of crypto investment products in the US. He's been a pioneer in the space, and what you've done is really bridge traditional investment management and finance with crypto over the last decade, and producing, between the championing of spot Bitcoin and Ethereum ETFs right now, these people are they were very early adopters, and obviously that applies to Dan Moorhead. We look at Pantera Capital, between venture capital, hedge funds, early stage token investing, a focus on exclusively in blockchain technology and digital assets. And I think, Dan, you started out here when Bitcoin was at 65, if I'm not mistaken. So obviously, the IRR on that is uncalculable, but the MOIC has been pretty good. So with that in mind here, we're going to go through the convergence of traditional and digital finance. We're going to talk about the institutionalization of the products. We're going to talk about new product paradigms and regulatory tailwinds. Let me get into it here right now, and thank you again, everyone. And I'm going to go down the line with different questions, and I may or may not stick to the script. We'll see how we do here. Eric, let's start out. As the leading crypto-native exchange, how do you see your role evolving as the traditional asset managers, move into your space or encroach on your space, depending on how you want to define it? We'd love to hear your view and start us out.
Thanks, Leon. That's a great question. I think what has not changed over the years is our mission. You mentioned bringing crypto to every wallet, and more importantly, accelerating the world's transition for people to use cryptocurrency and digital assets more broadly. We started very focused on retail, you mentioned it, very B2C, and we built over the years the largest on and off ramp between traditional money and digital money through 80 bank partnerships over the years. We also launched the largest card program so people can actually spend and use these digital assets in the real world. And today we have 140 million users that are using those services. Over the last few years, we saw institutions coming into the space. So our role really evolved to be more like a critical infrastructure partner of these institutions, working together as a custody partner, as a liquidity partner, or even as a staking partner when new financial products and innovation was being built from the traditional institutional side. We became the largest USD-supported exchange globally last year. So with deep liquidity, we acquired a trust company in the US, became a qualified custodian. So all these very important infrastructure pieces that traditional players need to enter the space. So we've been great partners with many firms on this panel and others that you mentioned, and we'll continue to do so to help the space grow through this B2B engagement.
And you envisioned, in fact, crypto in every wallet, especially for the unbanked? In other words, many people have smartphones that don't have bank accounts. You should be, and your partner should be, the method to which they can effect payments. Is that fair?
Definitely. I think if you want to get crypto in every wallet, you need to think billions. Today, I think in the space, in the industry, we have about 700 million users that are using cryptocurrency day to day. How do we get to 2-3 billion? You need to broaden the spectrum. You need to help people that not necessarily are not banked, but are at least poorly banked.
Right.
So remittances, getting access to decentralized financial services at a better cost is definitely a value proposition for the industry.
Sandy, let's get on to the institutional side. Franklin Templeton, one of the great asset management firms in the world here right now. Where do you see the institutionalization of digital asset management heading in the next few years? And frankly, given your, if I could say, your traditional roots, what's the role you think that Franklin Templeton is going to play in this evolving future?
Yeah, so I think that one of the most exciting things about working at a firm like Franklin is that we're nearly 80 years old, right? You don't make it 80 years in an industry if you don't embrace and understand innovation and how innovation transforms firms. And so we have really seen through Jenny Johnson's leadership a commitment to understanding and deploying these new crypto technologies, blockchain, smart contracts, cryptographically protected wallets, Oracle networks. These are the new technologies right along with Gen AI that are going to define the next iteration of our economy in the world. And we saw very early at Franklin Templeton that they had the opportunity to significantly enhance the way that the entire financial ecosystem operates. Right? We have not seen a major upgrade in how our financial market infrastructure performs since we redesigned it in the early 1970s, right? We are dealing with a 50-year-old approach that we put into place because we could no longer keep up with the volume of trading that was starting to happen. And so we've developed all sorts of novel ways of netting down exposures, creating all sorts of delays in the settlement cycle to give systems time to catch up. And these technologies represent an opportunity to completely go back to being able to trade one transaction at a time, but at a velocity and at a volume that will allow us to significantly expand the opportunity pool. So to the point about crypto in every wallet, the wallet itself, the speed of the blockchain rails, is going to enable a new renaissance in what we can do with our own assets, both as individuals and institutions. And Franklin Templeton has been focused on building the infrastructure that brings together these innovations from the crypto space with the business models that have proven success from the traditional financial world. And so we're seeing the most adoption right now around collateral use cases, financing use cases, where we're able to use stablecoins, tokenized money market funds, and these new rails to bring together the crypto and the traditional financial worlds. And I think it's going to be transformational, the pace at which real-world asset tokenization takes place over the next 18 months.
So you think from your standpoint, with your Franklin hat on, that this is now going to exponentially accelerate as you go forward, having gone through this period with the early innovators.
That's right.
As we discussed, in our prep calls here right now, having gone through the period of SBF and the other things, now we're in a stable pace, which means acceleration from your view.
And I think that the regulatory environment and a growing understanding of the strength of the technology is really going to set the table for a much larger group of participants to really begin to participate.
Thank you. And John, it really leads to the question for you, and that is, you've been known for innovation in structured products for a long period of time. You've built a business with over 40 billion in AUM. What actually drove you to enter the space here right now, and how are you differentiating your strategy from that standpoint? How did you look and say, this space makes sense, and our expertise is going to have real value added and create the adjacent products that you're famous for?
Okay, that's a lot to swallow.
It's a lot, but I know you can do it.
I'll do my best. Let's start with the history of the firm has always been we're growth managers, we're active managers, and we're great risk managers. And that all stems from our founder, John Calamos, who's a pioneer in convertibles. And just the essence of convertibles, where you protect it in the downside, give a little bit of the upside, is kind of embedded in our DNA. So also, we're very, very strong in options trading. So we're continuing to look at how, in a lot of ways, democratize products where we take an intricate type of strategy, given like our market neutral, which is one of our flagship funds, and we're able to sell it to retail, and where they cannot do it themselves. So one of the things that we started looking at is the ETF market. Initially, it was non-active, it was passive, and that wasn't very interesting to us. But when the switch got flipped about 5 years ago, and we started, people started issuing active managed ETFs, and found that for tax purposes and everything else, that was an efficient wrapper to bring products, we got involved. And one of the things that we started with is principal protected products, S&P 500. So you can take a certain amount of the upside if you hold it for a year, but protect yourself 100% on the downside. Then the next iteration was based on NASDAQ. Same thing, upside, downside protected. Then we did Russell 2000. And the entire time, we were working and waiting for legislation, working with the SEC, and hoping that indices will be produced on Bitcoin so we can actually take the same type of strategy and then hit it with Bitcoin. So the minute the CBOE did an index on Bitcoin, we were able to structure, and there was enough volume and options to do the first principal protected Bitcoin ETF. And when we launched in January, the upside was approximately 11.65%. But if you held it for a year, you would have no downside. And it's ironic that when we launched, I think Bitcoin was trading at 104.5, and within a couple of weeks, it went down to as low as 78. And it really highlighted that if the people that have bought it did a great job in believing in it, because they weren't going to lose any money, despite the fact that Bitcoin went down a tremendous amount.
So in essence, you created a convertible.
Exactly.
It's synthetic convertible, but it's Bitcoin, not an equity or something else like that.
And it's very liquid. And if you wanted to sell it, even in the midst of the market, you might have been down 1% versus 20 or more. And you can flip it into the next quarterly. We do it every quarter, and then we will ladder these products. So that was kind of the history on how we got into the ETF market and got into Bitcoin, because we knew that Bitcoin is going to be, the bus has left the terminal. It's gotten so big, it's going to be an asset class that people need to participate in, and everybody will have a piece of it at some point, will be adopted. And what we have done is put an on-ramp to extending the ecosystem for people that have been scared. The last 15 years, everybody here will tell you it's been the best performing asset class, right? For sure, bar none. The volatility, however, has been crazy. So that's why we only have a lot of room, 12% participation in the United States, maybe 4% in the rest of the world. There's a ton of room of upside. So if mom and pop or our grandparents are hearing about this but are scared to lose principal, this is a way to get them into the product, to understand it, to get their feet wet, and we think we can increase the ecosystem.
Well, but that's phenomenal. And Peter, that ties in, because when we come over to you, you've been a long leader in the sector here right now. You have created a business that has set some interesting paces. Not alone, not the only one, but you've done, obviously Pantera has been phenomenal during that period too here right now. But now all these folks are getting into the business. How are you positioning yourself for the next decade here right now? Or do you think that some of the big asset managers are going to come in and make it much more difficult, given that they're adopting it? What's your view of the next chapter?
Yeah, first of all, thank you, Leon. A pleasure to be here, and a pleasure to be here with my fellow panelists. I will start with a quick mark-to-market on Grayscale, very brief. We are a crypto-native asset manager. That's all we do, crypto and asset management. We have about $30 billion of assets under management today, 36 investment products being offered to retail and institutional clients. And essentially, in two businesses. We have a private business that has one of the longest tenures in the asset class, has been around for 12 years. It's the DNA, the legacy DNA of Grayscale. And a public business that started last year with the launch of Bitcoin and Ethereum ETFs.
Yep.
What brought us to being a scale asset manager in the asset class is the same thing that will take us to the next chapter, to your question, which is to identify a handful of tailwinds in the marketplace that we have high conviction on, and then investing to build a company before they are here. So for instance, we see the wealth management segment coming into digital assets as a major tailwind that is going to happen relatively quickly.
You mean in terms of asset allocation for wealth management, that X%, whether it's 1, 2, 10, will start to get allocated into the sector?
Exactly. So for the last few months, we have been building all this stack that an asset manager needs to have in place to serve wealth management clients and serve them really well. From a national sales force to all the ancillary things that a sales force need to have to work well, micro research, product marketing, among other things. Another example would be our belief that clients will want more or different exposures in ETF format or wrapper. Bitcoin and Ethereum were a huge success last year, for sure, but we have many clients coming to us and saying, look, we want to actually have a diversification. We want to go up and to the right in the risk-return curve in terms of things we invest in, and we prefer to invest through ETFs. So we have been upping our pace of product development by about 5x this year comparing to last year in terms of product launches and filings to anticipate needs for this client. So these are just two examples, but in summary, the playbook is the same we've been using for a long time. Find a few tailwinds, have high conviction, and invest to capitalize on them when they arrive.
Yeah, which is going to be a very, very significant growth area. You know, I think from your standpoint here right now, given how well the business is positioned, it's going to be interesting to see when you have, you know, Warren Buffett this weekend talking about people should pick a few stocks but allocate everything else to index funds, you know, how people will take that comment but extend it and say, and part of index funds will be the ETFs that all of you are creating here. Dan, you've been patiently waiting there, but you know, but at the same time, for someone, you were first in creating the largest digital asset fund in the world here right now, and one of the largest. And you know, you sort of probably look back at all this, and some people you say, well, you all were here a little bit late to the party. I've been here for a very, very long time investing, especially given your historic background. What do you think will be the key inflection points for much more institutional adoption from your vantage point, especially given what I think is a highly, highly unusual history, because you truly were a pioneer?
Yeah, it's a great question, and I'd love to start by saying when we launched our first funds 12 years ago, we had some institutions. So institutions have been in the space for the whole time, but the spirit is like, what's the inflection that hockey sticks it, right? And I think we just had it. I think the US election is kind of the last remaining issue that our industry had. And admittedly, you know, when we were evangelizing for blockchain, you know, 8 or 10 years ago, there was a very long list of reasons to say no. There was no custodian, there was no this, there's no that. Now we have great firms like Franklin in the business, you know, Fidelity, BlackRock. So all of the reasons to say no have been taken off the table, with the notable exception until recently, US regulatory clarity was missing. And that really held a lot of institutions back. You know, it was a weird experience when you have the United States Securities and Exchange Commission suing Coinbase and Ripple Labs, great companies based in America, you know, that really try and do everything as squeaky as possible. So that gives an institution an excuse, at least, to hold off. And so I think the election was really big. Obviously, the current president is very pro-crypto. We all know that. The really big change, though, and people say, hey, well, in 4 years, maybe it'll be a different president, and maybe things, you know, will have changed one way or the other. I think we had a permanent change in Congress. There used to be a lot of people in Congress, they were anti-crypto. For the life of me, I don't understand. It's one of the best things that's ever happened to humanity. It's going to help 4 billion people transfer money and save money, essentially free. It's amazing compared to all the existing, you know, issues like remittance and credit card companies and all that stuff. But what happened was the industry got organized and competed in 58 congressional elections, and 54 of those, the anti-crypto person got kicked out of Congress. And so I think you're not going to hear a negative word out of Congress again, because one of the things we've been really early on, and the current president realized, the majority of Americans are under 40, and they love blockchain, right? And they vote, right? And so being anti-crypto is just, you know, is a non-starter for Congress. So I think that's changed. That will give institutions the ability to really get into the space. The United States has a strategic Bitcoin reserve, you know, so even the government is in the Bitcoin and blockchain business. And I think that the last perspective I'd share is I started out trading at Goldman when they created the GSCI. And now everybody thinks of commodities as an asset class, right? It's no surprise. And I was doing EM in the 90s, and now emerging markets, is obviously considered an asset class. I really passionately believe, I've seen this movie a couple times, in 10 years, every institution out there will have a blockchain team. It'll be in their strategic asset allocation. They will have a benchmark, and they have to hit it. And this is the reason, that it's still early, right? The internet's over 50 years old, and there's still really cool things coming out of the internet.
Exactly.
Blockchain's still a teenager, super early, although it's gone up a bit. I think over the next 10, 20 years, it'll go up way more. And the real proof is the median institutional investor has 0 direct blockchain exposure. So it's not even started yet. It's much, so once everyone does get into the space, we'll continue to drive assets.
Well, we're
up.
going to come back and talk to you about how you evaluate investing in blockchain and areas like that, because obviously, if you go back a few years ago, people would have said, blockchain we understand, that's all good, we can get that, we can put our art and our house on blockchain, but it's crypto we don't like. That has been, I think, the sea change that occurred. And thank you for the way that you went through that here right now, Dan, because it actually leads Eric directly into the question that I think is interesting and exciting, because we're living in uncharted territory. And that is, you're collaborating with Trump Media and Yorkville American Digital to launch Made in America crypto-related ETFs, is my understanding. Could you elaborate on the strategy here? What's the update of the launch, et cetera? Because you obviously have a very excited administration, as Dan was talking about. Where are we heading with this?
Yeah,
a nice branding, very good branding that you got there.
I'll concur that I think the launch of the Bitcoin ETF in the US was an inflection point for the industry. And of course, the election in November of the new administration reinforced that. But the whole ETF space is where we actually can work together with the traditional financial space to broaden the mainstream distribution of digital assets. And we started with Bitcoin, but now we're doing baskets, we have Ethereum, and many single token ETFs that are coming to the market. So as I said, our role has evolved, and we are supporting now traditional financial firms in launching those ETFs from a custody standpoint, from a liquidity standpoint. And very excited with this partnership with the Trump Media organization. But there's many more. Just today, 21 Shares also launched another single token ETF that we're supporting. There's many more. We're working with many of these partners to do that. I think it's a great new inflow into the space. You mentioned, tens of billions of inflow came to the Bitcoin ETF in the US. Volume-wise, it's almost $1 trillion that has been traded on all the Bitcoin ETF to date. And the distribution is already there. You are trading on any broker-dealer today, you have access to the ETF. It's giving exposure and an entry point for so many new users. For us, it's really about supporting liquidity custody with these different players and helping them navigate and expand the number of tokens, the strategies around the ETFs.
But also on that point, which really I'm going to come to Sandy on, there's so many different names sitting out there, in terms of what's a token, people coming up with their own various brand names, between tokenization, et cetera. What that can also lead to, frankly, is mass confusion, in my opinion, in terms of the retail landscape. But Sandy, as a firm that's actually incredibly careful about what products you're putting out there, let's talk about risk management and compliance here right now and put a real damper on the conversation. How is Franklin Templeton approaching this differently when it comes to traditional assets versus digital assets? What's your view here? Because I presume by definition you want to be extra careful. What's your view?
Yeah, so I think as everyone has discussed, there's an amazing opportunity emerging in the crypto space. And to access it, you have to own the crypto, right? The ETFs have been a great way of opening up attention and understanding about what these new investment vehicles offer. But it's like saying, I love search, but I'm not going to own Google, right? You need to own the underlying coins to be able to really get the exposure of the growth and the innovation that's happening in the space, right? This is a new way of running a platform and a network, right? Today you have networks like Uber, you have networks like Amazon, you have networks like Airbnb, where you have very powerful intermediaries, and those intermediaries control the economics. These new networks are decentralized, and to control the economics, you need to have an incentivization mechanism, and these tokens are the incentivization mechanisms that make the network effects operate. And so everyone is going to come to understand that these are the next wave of investment opportunities, but to own them, owning them in the ETF is fine to get familiar with them, but the ETF still sits in our traditional account-based systems. The new instruments, when you go to the tokens themselves, they sit in cryptographically protected wallets. And we as an industry are going to be moving over the next 5 to 10 years away from our account-based systems to a wallet-based system. And so we have built that wallet-based system already at Franklin Templeton, and we have found significant enhancements in being able to use these new technologies to deliver, particularly around risk, right? We are able to calculate, as a transfer agent running our product on the blockchain, second-by-second shareholder records. Right? We can calculate a shareholder record and pay out interest on a fund like a money market fund every single calendar day of the year. Right? We operate 24/7. We can give out and redeem our products 24/7 on our new infrastructure. We are able to program in regulatory compliance via smart contracts and have extra layers of checks without having to add personnel to support them. And so what we're finding is that when you embrace these new technologies, there are amazing opportunities to build our processes better. We don't get many opportunities in life to go back and have a whiteboard and redesign the industry, but what we have in this moment is that opportunity, and we are finding tremendous benefits from doing so.
And it's also going to be interesting in, having spent a lot of time over the years in the private markets, how this is going to translate over time into the private markets that require, 100-page documents. People don't really understand that absence of complete liquidity.
Yep.
And, if you want your money, you can go wait for 3 months or 6 months or a year. So what you're putting in place is probably, and everyone, is actually the foundation that's going to extend. And my own personal opinion is that we're at the early stages of this. But John, that really ties into my question. When you look at these hybrid products right now, both digital assets and traditional, do you see this becoming a significant part of people's AUM from that standpoint? When you talk about both wealth management and traditional asset management, you're a firm that's looked around the corner for a long period of time. Where do you see that going in terms of percentage of AUM and importance?
Look, I think that it definitely is going to be part of a significant portfolio. A lot of our products are retail focused. We do have institutional stuff as well. But we're seeing it in both ends, right? And even in the private markets, let's look at how they've developed in private credit and private equity. If you look at traditional sovereigns, on allocations, they might be at a minimum 10% to maybe even over 40% in different private type markets.
Right.
So now if you look at in the wealth management space, that number is single digits. So there's huge amount of growth that we're seeing transform where retail is going more into the private sectors with these new instruments like interval funds and what have you. I think it's the same thing. When you have people like Larry Fink in talking to these sovereigns, and the question is not, are you going to partake in Bitcoin? It's how big is the allocation? Is it 5% or is it 10%?
And also, you and I have grown up with the old 60-40. What happens to that in this context here right now as people start to think about the asset allocation? Does it blow that whole model up?
Well, I'm not sure 60/40 has really been relevant for several years now. I mean, it's been really
But it's still
turned around
talked
and it's back and changed tremendously, given all the different cycles that we've seen. So it's here to stay. It's going to be part of it, just like all alternatives are being a bigger, as you know, it's just kind of the insatiable thirst for yield and performance that both institutional and retail are looking for. And to do that, we're continuing to, come up with products that give it to them. So it happens in the institutional markets. It's followed in the retail markets. It's happening with all the alternatives. It's gonna happen, and it's happening with crypto.
Exactly right. And Peter, that leads into the question that I have here, just picking up on what John said, as the retail demand continues to grow, which you're an important part of here right now, how is it influencing the way that wealth advisors and wealth managers are approaching the asset class, given, frankly, that certainly some of them are, if I could say, uneducated about it and don't necessarily understand it, if that's a fair way. How do you see that growing here with those advisors?
Yeah, Leo, it's interesting. I've been in asset and wealth management now for over 20 years. I've never seen a 180 like I've seen with wealth advisors in the last few months. So it used to be until recently that it was a career risk for advisors to recommend these products to their clients. There was reputational risk, there was regulatory risk. And then two big things happened last year, and I think we touched on some of them. The launch of ETFs that brought many well-known institutions, the financial advisors trust into the game, as Dan was alluding before, and then ending the year in a much more favorable regulatory outlook. These two things compounded with the fact that digital assets was the best performing asset class across all asset classes in the last 5 and 10 years, changed the game. And now advisors tell us that it's a career risk for them to not understand it and not be able to have a conversation with their clients about it. So for Grayscale, we went very quickly from being on the do not call list of wealth advisors to having 5,000 calls so far this year when they are looking for research, they are looking for education, they are looking for materials they can use with their clients. It all happened in a matter of months, which is very, very quickly for this type of business. And we are in conversations now with over 50 of these wealth platforms in terms of porting our products into their, just as a matter of fact, like last week on Thursday, we hosted a home office day for Grayscale, and we had about $30 trillion in the room of people that wanted to know more about the asset class and how to incorporate it into clients' portfolios. I don't think we'll be able to have had a similar meeting last year.
Yeah, and by the way, do you think that part of it is the regulatory side, or do you think it's just the natural evolution of where we've been going here for the last few years?
I think it's both, but the regulatory framework and the positive outlook on that framework, I think is transformational.
So it makes a big difference. But Dan, going back, because I'm so fascinated by the approach that Pantera is taking right now in terms of how you've actually invested, how you've actually approached investing in some of these. And I look at blockchain and digital assets, and then I think about traditional venture capital, which I'm very familiar with. How does it compare in terms of when you're looking at risk, return, timeline, market competition, and you evaluate? Are you using similar techniques, or is this a whole new world from your standpoint?
Yeah, so there is one unique feature on blockchain that's super important. It's the first time in history you can own a piece of the protocol. So if you think about it, if you went back in the 90s and you were prescient enough to think, this internet thing's going to be big. I want to buy a chunk of the internet. You couldn't buy a piece of the internet. All the protocols that we now call the internet, HTTPS, all that, are not something you can own a piece of. Bitcoin is the first protocol you can own a piece of. There are 21 million shares of Bitcoin. And so the line earlier is, I love blockchain tech, but I don't like Bitcoin. Well, you can't operate blockchain tech without the token. So if you think blockchain technology is important, you have to, and you can, that's the important point for investors in the room, buy shares in the protocol. And so that adds just a whole new dimension compared to the internet or any other venture capital investing. And those typically go live within a year or two and get liquid much, much faster than a private company would. But on the venture side, we're raising our 5th venture fund right now. The first 3 only had venture equity. They didn't have tokens, they didn't have anything, just pure venture equity. All of them paid back all the investor capital within 4 years. And 4 or 5 times capital within 5 years and 10 times capital over a period of time. That's just so different than kind of the real world or the normal venture world. Because the blockchain companies, it's such a dynamic space. There's an enormous rising tide. It's allowing exits to happen. An amazing stat is we've invested in 22 unicorns. Like, you can't do that in kind of a normal space. And so for those of you that don't have any exposure to blockchain, it's so important to get in there because the returns happen faster. Distributions, which is a huge issue for many of you out there. We've created $5 billion in profits for our LPs and distributed 100,000 Bitcoins to them. We are trying to recycle this because it happens much faster, than the normal venture industry. And the important thing is it's historically very low correlation with risk assets. Bitcoin, as a proxy for our industry, has a 13-year correlation with the S&P 500 of 0.1. So if you can find an asset that has a 13-year compound annual growth rate of 90% that has 0.1 correlation, you got to put a little bit in the portfolio.
But let me ask you just to follow up. As you evaluate, when we look at VCs that evaluate based on MOIC, IPO, M&A, et cetera, are you looking at those same kinds of exits from your standpoint?
We do, yeah. So investing in venture equity, we're looking at exactly the same things that normal venture investors do. But when we're investing in protocol tokens, there's one extra little dimension, or important dimension, is most of these are open source protocols that rely on a community of developers to make them function. And so when we evaluate investing in protocols, we have to see, is the management team compelling and going to generate, all of the people, the developers to come in and build things to make, the entire ecosystem work. And that is different. And there are some, like Ethereum and Solana, where the management teams have done an amazing job, getting huge amounts of developers excited. And then there are, 20,000 other tokens that haven't been able to do that.
Let me ask I've got some questions from the audience, but I got the prerogative of asking some on my side. From your perspective, and I'm going to ask each one of you the same question, what's more important right now, innovation or regulation? Which I think is a pretty interesting issue when you think about where we're at. Let's just go down the line. Eric?
I think it's a balance, right? Regulation is to bring clarity so business can build, but if you put regulation before innovation and businesses, then you end up in situations sometimes like certain markets that regulate too early and then there's no business. So that's that fine balance that needs to be found. And it is always delicate, and each country has its own objectives and way of protecting investors and consumers and goals as well, so you have to adapt to that. But one doesn't go without the other.
Sandy, what's your view? Because you're right at the cutting edge of thinking about these things.
I am a firm believer that innovation is the most important. We often talk about how regulators are solving the last issue that came up for the industry. We face a more existential problem right now, that the innovation is outpacing the regulation by such a significant degree that we have to now rethink regulation, not rethink how new innovations fit into regulation. We need to rethink regulation itself. And so I think that innovation has now so far outpaced regulation that it is forcing a reconciliation, and that is why the attention has turned to regulation, because innovation is just occurring at such a fast pace right now.
John?
I think innovation is the carrot and I think regulation's a stick, and you need both, right? You need to push by innovation, but unless you have regulation, so deregulation is usually a really good thing. In this market, you need a little bit of regulation in order for it to actually tick, right? So I think that what's really important and what we've seen is we were innovators and we knew what we wanted to happen, but we weren't allowed to do it till the regulations caught up with how we were thinking and what we wanted to do. And there's still a lot of pipes that are clogged that need to be opened, and there's a huge hurdle of adoption of all the major firms, all the wirehouses and stuff. They still aren't just opening up to anything that's Bitcoin related, but they're getting there, right? And the reason they're getting there is because the regulations are starting to happen so they can feel more comfortable in order to have that insurance policy.
Yeah. So Peter, I'm going to go to you and Dan, obviously, because you've been here a long time and you've got, I presume both of you have some scars on your back on this. How would you answer the question? Peter, you go first, and then Dan can decide if he agrees.
Yeah, look, for our business, I think both are extremely important. I would say on the innovation side, it's such a nascent asset class that innovation will probably have to come even later. We're still inventing what the asset class, asset management looks like. We're not trying to fine-tune it at this point, but rather create it. That said, one commitment we have at Grayscale is to provide our clients institutional caliber infrastructure, risk management, compliance capabilities, operations, and our job will be made much easier if we had clear rules of the game, even more clear rules of the game. So I would say if I had to choose between one and the other, I would choose regulation today because innovation is already happening.
Okay.
Yeah, I would say,
Mr. Innovation too. How do you feel?
I was going to say, the blockchain innovation is so powerful. It's going to change the world for billions of people, regardless of what regulators do or say. However, what regulators do or say could either retard it or speed it up, and it could drive it away from the United States or to the United States. And that's what I've seen over the past 5 or 6 years. Is in the early days, 2013, 14, 15, the vast majority of projects we invested in were based in the United States. Then there was a really scary period where entrepreneurs were leaving the United States or forming companies outside the United States. And a great example would be Singapore has an incredibly rational regulatory regime. It's the largest destination for our investment outside the United States, because they have a great regulatory regime, so entrepreneurs go there. And I hope it'll swing back now to the United States and have more entrepreneurs here, which, remember, the internet, all the massive internet companies in the free world are based in the United States because the government had a great regulatory regime. So I would love to see that in blockchain.
Yeah, and remember, overregulation has killed historic markets. I mean, London Stock Exchange used to be important. A little bit overregulation, created an issue there. Let me go to one question here from the audience before I go back. It's actually, for large-scale adoption, how important will it be for everyday venues, grocery stores, gas stations, et cetera, to have crypto as normal payment options? And that, I presume, also relates to stable coin, et cetera, so that you can, if you have $1, you can get $1. How do you think? For Crypto.com, that's so focused on retail, what do you think of that?
I think commerce adoption is critical. You need to be able to use those digital assets for day-to-day use cases. Otherwise, it just remain an investment vehicle. It's still important to have in your portfolio, but you actually use the technology and the power of it. We started initially by using traditional tools like a debit card, so people can actually use those in a day-to-day environment, but it still goes through the traditional rails, and it's still expensive for merchants. So when you use native crypto technology, then the fees are extremely low for merchants, and people can actually start using in their day-to-day life crypto. So I think it's going to be important. Probably online commerce will come first, and they will be one of the large e-commerce players that will do it. They're all thinking, working through it. When that happens, I think there will be a snowball effect, and many more merchants will start adopting it.
With the key being stability. Any other comments from other folks on the panel in terms of adoption there? Sandy?
I'm going to take a little bit of a contrary view, and I don't think that cryptocurrencies will become ever big in payments. I think that cryptocurrencies are meant to pay for block space on the blockchain. And we will be using stable coins, we will be using digital forms of money, we will be using tokenized gold, tokenized diamonds to pay for things, and then we will have bits of cryptocurrency in our wallet to then pay to record that transaction. I don't think it's going to be used to make transactions in the everyday economy. It's really meant to buy block space on the blockchain.
Yeah, I would say that, there are certain things that are totally broken, like remittance. The average migrant spends an entire month working for their remittance company, and their family only gets 11 months' wages. Blockchain, anybody with a smartphone can send money back home, and already 10% of all US to Mexico remittance is going over Bitcoin because it's just way better.
So, but the remittance also relates back to something we touched on earlier on, Dan, and that is something I care a lot about, which is the unbanked. And in essence, the unbanked may not have a bank account, but they'll have a smartphone. And that becomes the essence of how they can end up creating a much better structure in terms of remittances. There's plenty more questions here right now, but we're going to run out of time. And for those of you that don't know, we're not in between you and drinks, we're in between you and Mike Milken speaking. So I know exactly when to end. Let's go through a quick lightning round in terms of questions. People always get a little confused on this, so if you need any help, I'll try. Long and short. Are you long or short tariff trade deals? Do you think are you long? Are you bullish that these trade deals will be good, or are you short the trade?
I certainly hope we get clarity and stability in the trade war, so looking forward to that.
So
Short.
Short? Yeah. We have the audience voting too, which is even better. John?
I think the results, I'm very bullish. I'm going long.
Okay. Peter?
I'm optimistic in the medium term, so.
Yeah, I think a lot of damage is being done to government-sponsored currency, so this is great for separation of money and state, Bitcoin, crypto.
Okay. Let's go to something slightly different but related. The value of gold.
Long-term, long, and I think even longer with leverage on Bitcoin, which is digital gold.
I missed the question.
Gold.
Oh, gold. Oh, I think gold and all commodities are going to have a renaissance with tokenization.
Which we didn't spend enough time on. It's for another time, but that is important. John?
I agree with that.
Same here.
Yeah, bullish gold and digital gold.
Well, and then sort of let's end on the one that is fascinating as part of this, even relates partially to the question where I understand what Sandy said and probably agree. Stable coins.
It's already the largest tokenized assets in the world. It's like almost $200 billion. It's going to be super important for remittances, for payments, for movement of stable value across the blockchain. So extremely bullish. There's more regulation in a positive way that is coming to bring more participants in. So long.
Stablecoins are already rewriting global trade, and they are rewriting the rules of banking, and they will continue to do so and force change to ripple throughout the entire industry.
I couldn't have said it better myself. Definitely
I'm very
agree
bullish
with
on
that.
that too.
If stablecoins were a country, they'd be the 12th largest holder of treasuries. Like, they're already massive. And this is the out of consensus prediction, but in 15 or 20 years, they will have replaced banks for most of their deposit taking.
Yeah, I think it could have a very, very long-term impact in terms of what happens from a deposit standpoint. You're absolutely right. Listen, I want to thank the panel. Please join me in giving a hand. I think this was a fascinating conversation. And I didn't ask for the predictions of prices and all the rest of it here right now, but I think it's fair to say that everyone walks away from this that this is an asset class whose time has come after a long, long period of time, and I think we will see this becoming a reasonable part of people's portfolios on a personal basis, and certainly the same thing on an institutional basis. So thank you for spending the time today.
Thank you.